All right, welcome to the deep dive. So glad you're joining us today.
Great to be here.
We're going to tackle something that sounds maybe a little intimidating tax-wise, but it's actually a super common, really powerful choice for lots of small businesses. We're talking S corporations.
Yeah. And I know taxes can make your eyes glaze over sometimes.
Right.
But this one, understanding S Corp, it can really change the game for how a business gets taxed and, how much money actually ends up with the owners.
Exactly.
Yeah.
So we're going to try and make it clear. Okay, let's unpack this.
Let's do it. Our mission today basically is to cut through the jargon, find those nuggets of knowledge about S Corp, make it digestible, make it relevant, especially if you are a business owner or thinking about starting one or even just curious how this stuff works.
Yeah, think of it like picking the foundation for a house, right?
Yeah.
Choose the right tax structure, you build on solid ground. Choose wrong, well, headaches.
Definitely. So today is all about building a clear understanding of that S Corp foundation.
Perfect. So where do we start? The big picture.
Yeah, let's start there. We'll define it, look at who qualifies, how to actually become one, what might kick you out of S Corp status.
Okay.
Then we'll get into the real, the mechanics, how the money flows through, this thing called basis, another thing called the accumulated adjustments account, or AAA, the whole journey.
Okay, so setting the scene. A business starts, maybe just you, then it grows, decides to become official, incorporate. What's the default tax situation when that happens, and where does this S corporation idea fit in?
Right, that's the fundamental starting point. When you formally incorporate, you create a separate legal entity. And by default, for tax purposes, that new entity is a C corporation.
The standard corporation people think of.
Exactly. Think big companies, public companies, they file their own tax return, Form 1120, they pay corporate income tax on their profits.
Okay.
Then, if they distribute those profits, say, as dividends to the shareholders,
Right.
well, the shareholders pay tax again on their individual returns.
The famous double taxation.
That's the one. Infamous, maybe. Now, an S corporation is different. It's still legally a corporation, same entity type usually, but it's a special tax election you make with the IRS.
So it's a choice about how you're taxed, not what you are legally.
Precisely. And the absolute biggest difference, the core concept, is that it's a flow-through entity. It's designed specifically to avoid that C Corp double taxation.
Okay, flow through. That sounds key. How does that actually work? What flows through?
Think of it like a direct pipe. All the corporation's income, gains, losses, deductions, they don't get taxed at the company level.
No corporate tax bill.
Right. Instead, they literally pass directly through the pipe to the shareholders' individual tax returns, proportionally based on ownership.
So I pay the tax on my share of the profit on my personal return.
You got it. And here's a really, really important point for you as an owner. You are taxed on your share of those S Corp earnings, even if you don't actually receive the cash.
Wait, really? So the money could still be in the company bank account, maybe for reinvestment?
Yep. Reinvested, sitting there, whatever. You still owe tax on your share of it for that year.
Huh, okay.
Now, that sounds a bit like how partnerships are taxed, right? Partners also get taxed on their share regardless of distributions.
Yeah, I've heard
Then it is similar in that respect, but, and this is a big, but we'll get into, there are some major differences, especially around something called self-employment tax. Big potential savings there with S Corp.
Okay, interesting. So the income avoids corporate tax, hits my return directly. But it sounds like maybe not every business can just decide to be an S Corp. What are the rules? The gates you have to pass through.
Exactly. It's not for everyone. There's a very specific checklist, and you have to meet all these requirements and keep meeting them to qualify and stay qualified.
Okay, lay them on us. What's first?
Requirement 1. It has to be a qualified corporation, and specifically a domestic one, meaning it needs to be incorporated under U.S. law, typically in one of the states. So a company formed in, say, Mexico or Germany couldn't be a U.S. S Corp.
Makes sense. Can an S Corp own other companies?
It can, yeah. An S Corp can own stock in a C corporation, even 100%. But here's the catch for taxes. They can't file a consolidated return together. They file separately.
Okay.
But there's a neat strategy. An S Corp can own 100% of another corporation and elect for that subsidiary to be treated as a qualified S subsidiary, or QSS.
QSS.
Yeah. If you do that, the QSS isn't treated as a separate corporation for tax purposes. Its assets, liabilities, income, deductions, they're all treated as belonging to the parent S Corp. So they file effectively as one entity. It's useful for structuring different parts of a business.
Ah, okay. So domestic company. What's next on the checklist? Who can own the S Corp?
Right. Eligible shareholders. This is another area with pretty strict rules. Generally, shareholders must be individuals, estates, or certain types of trusts.
Individuals, okay.
Like me. Yep. But, crucial exclusion here, an individual shareholder cannot be a non-resident alien.
Why is that?
It really simplifies things for the IRS regarding tax jurisdiction and making sure that flow-through income is taxed properly within the U.S. system. Avoids a lot of complexity.
Got it. Any surprises in who can be a shareholder?
Yeah, a couple maybe. Qualified retirement plans, like your 401k or an IRA, can be shareholders, and also 501c3 charitable organizations.
Oh, interesting. So a charity could own part of my S-Corp.
Potentially, yes.
Yeah.
It opens up some flexibility for certain investment or giving structures.
What about other businesses? Can a C-Corp own an S-Corp
Right?
or a partnership?
Absolutely not. That's a hard no. Neither corporations nor partnerships are eligible shareholders. That's fundamental. It keeps the ownership structure relatively simple and prevents complex chains that could obscure the flow-through taxation.
Okay, so individuals, estates, some trusts, retirement plans, charities,
Hmm.
but no corporations or partnerships.
Got it. What about the number of owners? You said closely held earlier. Is there a limit?
Yes, there is. Requirement 3, the shareholder limit. An S-Corp can have no more than 100 shareholders.
A hard cap of 100. A hard cap. But there's a really important exception, especially for family businesses.
Oh,
Family members can elect to be treated as one single shareholder for this 100 count.
really? How broad is family?
It's pretty broad. A common ancestor, all their lineal descendants, children, grandchildren, great-grandchildren, and their spouses, even former spouses.
Wow, okay. That's a huge help for keeping a business in the family across generations without hitting that 100 limit too fast.
Absolutely. It's a very practical advantage.
Okay, so
Uh,
domestic, right? Shareholders under 100. What else? Anything about the stock itself?
Yes, the final main requirement, the one class of stock rule,
You mean?
meaning the corporation can only have one class of stock outstanding. The idea here is that all shares must have identical rights to distributions and liquidation proceeds.
So everyone gets treated the same economically per share.
Exactly. It keeps the allocation of that flow through income and loss nice and simple. If you had different economic rights, it would get messy fast.
Can you have voting and non-voting stock?
Yes, that's allowed. Differences in voting rights for common stock are perfectly fine. So you could have Class A voting shares and Class B non-voting shares. That lets you separate control from pure economic ownership, which founders often want.
But you can't have, like, preferred stock.
Correct. Preferred stock is forbidden. Preferred stock usually has different rights, like a fixed dividend preference or priority in liquidation, that violates the one class of stock rule because it creates different economic rights. S-Corp need that simplicity.
Man, that's a lot of hoops to jump through. Domestic eligible shareholders, max 100 with the family rule, one class of stock. So let's say you check all those boxes, you're eligible. How do you actually do it? How do you make the switch and tell the IRS, we want to be an S-Corp?
Right. Making the actual election, the process itself isn't overly complicated on paper, but the timing is absolutely critical. Get it wrong, and you can face some unwelcome delays.
Okay, heads up noted. What's the first step?
First, you need consensus. This is the all-in rule. All shareholders must consent to the S election, and that means everyone voting shares, non-voting shares, everyone with any ownership stake.
Everyone has to agree. Makes sense. How do they show that?
They formally consent, usually by signing Form 2553, election by a small business corporation. That's the form the corporation files with the IRS to request S status.
Form 2553. Got it. Now, the timing you mentioned.
This is the big one, the deadline. If you file that Form 25553 by the 15th day of the third month of your corporation's tax year,
Okay, 15th day, third month.
then the election is effective as of the first day of that same tax year.
Retroactive.
Exactly. So let's take the most common case. A calendar year corporation, tax year ending December 31st. If they file Form 2553 by March 15th,
The 15th day of the third month.
the S election is effective back on January 1st of that same year. You get S-Corp treatment for the whole year, even though you filed a bit later.
That's huge. What if you miss the deadline? File on March 16th.
That's where the delay comes in. If you file after that deadline, after the 15th day of the third month, the election generally doesn't become effective until the first day of the following tax year.
So, miss March 15th by one day, and you're stuck being taxed as a C-Corp for the entire rest of that year. And the S status only starts next January 1st.
That's typically how it works, yes. A potential year-long delay, potentially meaning a year of C Corp taxes you didn't want. It really highlights why you need to plan ahead, work with your tax advisor, and hit that deadline.
No kidding. Okay, so you make the election successfully, it's in effect. What happens if a new shareholder comes in later? Do they have to consent too?
Good question. And thankfully, no. Once the S election is valid and in effect, the consent of a new shareholder is not required.
Oh, that simplifies things. Like selling shares or bringing in new investors.
Absolutely. The S status just continues automatically unless something happens to terminate it, which we'll talk about next.
Okay, and quick practical point, what tax form do S Corp file and when is it due?
S corporations file Form 1120S. That's the S corp equivalent of the C corp's 1120. And as for the tax year, the default rule is they must use the calendar year.
So ending December 31st.
Right. You can sometimes get approval for a different fiscal year, but you need a solid business purpose, like aligning with a natural business cycle. But for most, it's the calendar year.
And the due date for Form 1120S.
It's the 15th day of the third month after the end of the tax year. So for a calendar year S corp, that's March 15th, same as that critical election deadline.
March 15th is a big day for S Corp. Okay, so you jump through the hoops, filed on time, you're operating as an S Corp. But you mentioned termination. It's not necessarily permanent. Can you lose that status?
You got it. S status isn't locked in forever. It can end, sometimes intentionally, sometimes not so intentionally. And yeah, the consequences can be pretty significant. Think of it like that house foundation again, and got to be aware of things that could cause cracks or even demolition.
Okay, so what are the ways out, the terminating events?
There are basically three main ways an S election can terminate. First is voluntary revocation. This is when the owners decide, you know what, we don't want to be an S corp anymore.
They can just choose to stop.
If shareholders holding more than 50% of the stock, and that counts both voting and non-voting shares, consent to revoke the election, then it's revoked. So the majority owners have the power to switch back, maybe if the business gets too big, or C Corp status becomes more attractive for some reason.
Okay, so the owners can choose. What's the second way?
Second, and this is often the one that catches people by surprise, is failing the qualifications.
You mean not meeting those eligibility rules we just talked about?
Exactly. If the corporation at any point stops meeting any of those requirements, boom.
Yeah.
S status terminates immediately.
Like what? Give me an example.
Okay, let's use illustrative example 1. S corporation termination. Imagine small corporation. They've been a happy calendar year S corp for 10 years. On February 1st this year, they bring in a new investor, large corporation, which is a C corporation. Large Core buys 40% of Small Core stock.
Uh-oh. A C Corp can't be an S Corp shareholder.
Precisely. So the moment Large Corporation became a shareholder on February 1st, Small Corporation ceased to meet the eligibility requirements. Its S election terminated immediately on that date, February 1st.
Wow. Just like that. Accidental termination.
Happens more often than you'd think. Maybe they accidentally issue a second class of stock or go over 100 shareholders without realizing the family rule implications. Constant vigilance is key.
Yikes. Okay. Voluntary revocation, failing qualifications. What's the third way?
The third one is a bit more specific. Excess passive investment income. This rule is a little tricky.
Passive income, like rent or interest.
Yeah, things like royalties, rents, dividends, interest, annuities. But this termination rule only applies if two conditions are met. First, the S corporation must have accumulated earnings and profits, EMP, from a time when it used to be a C corporation.
So it has leftover C Corp profits hanging around.
Exactly. If it was always an S corp, this rule doesn't apply. But if it converted from C to S and has that C Corp EMP, and then second condition, more than 25% of its gross receipts come from that passive investment income for 3 consecutive years,
3 years in a row,
then its S election terminates. That prior C Corp EMP is the key trigger here. Without it, passive income alone won't cause this type of termination.
Got it. So if your S status does terminate for any of these reasons, what happens then? Can you just flip back next year if you fix the problem?
No. The IRS puts you in the penalty box for a while. Generally, once an S election is terminated, the corporation has to wait until the beginning of the 5th year after the year of termination before it can elect S status again.
5 years. Wow.
Yeah, it's a significant 5-year lockout. They don't want companies jumping back and forth easily based on short-term tax whims. It really emphasizes the importance of staying compliant if you want to keep that S status.
Okay, so the election is made, or maybe it gets terminated. But the whole point, the big draw, is that flow-through idea. Let's really get into the nuts and bolts of that. What exactly flows through? How does it get reported? And how does it hit my bottom line as a shareholder?
Right, this is the heart of it. This is where the S-corp structure really shows its value, or potentially its complexity, for you as the owner. Like we touched on, it's similar to partnerships in that the S-corporation itself doesn't pay tax. Instead, its financial results flow through.
What flows through? Just the final profit number.
Not quite. It's more detailed than that. Both the ordinary business income or loss and specific separately stated items of income, gain, loss, and deductions flow through.
Okay, ordinary income loss and these separate items, how are they allocated? If I buy shares halfway through the year,
Good question. The allocation is done on a per share per day basis.
per share per day.
Yep. So the system calculates exactly how much income or loss corresponds to each share for each day of the year. If you own 50% of the shares for the first half of the year and 60% for the second half, your allocation reflects that precisely.
That seems fair. Now, you mentioned a big difference from partnerships earlier.
Yeah.
Something about tax savings.
Ah, yes, the crucial distinction. Self-employment tax. This is a major benefit of S-corp for active owners.
Okay.
In a partnership, if you're a general partner actively working in the business, your share of the partnership's ordinary business income is generally subject to self-employment tax. That's Social Security and Medicare taxes, currently around 15.3%.
Right, I've heard that's a big hit.
It can be. But in an S corporation, even if you, the shareholder, work full-time in the business, your distributive share of the S corporation's ordinary business income is not subject to self-employment tax.
Seriously, none of it.
Well, there's a key caveat. The S corp must pay you a reasonable salary for the services you provide. That salary is subject to regular payroll taxes, Social Security and Medicare, paid partly by the company, partly by you. But any ordinary business income distributed to you beyond that reasonable salary comes through without the additional self-employment tax hit.
Wow. So salary gets payroll taxes, but the profit distributions on top of that avoid the SC tax.
Correct. That's a huge planning opportunity and a primary driver for many businesses choosing the S-corp structure. Significant tax savings potential there.
Okay, that's a big one. Now back to those separately stated items. Why pull things out separately? Why not just lump everything into ordinary business income?
Great question. It's all about ensuring the correct tax treatment on your individual return. Certain items need to be handled differently because they might be subject to specific limitations at the individual level, like charitable contributions or certain losses, reported on different tax forms or schedules on your 1040, taxed at different rates, like long-term capital gains versus ordinary income. Ah, okay, so the S-corp K-1 breaks them out so I can handle them correctly on my return. Exactly. Your Schedule K-1, that's the form you get from the S-corp, lists your share of ordinary business income loss, but then it has separate lines for things like rental real estate income loss, interest income, dividend income, royalties, net short-term capital gain loss, net long-term capital gain loss, net Section 11231 gain loss, this often comes from selling business assets, charitable contributions, the Section 179 expense deduction, a special way to deduct asset purchases immediately.
That's quite a list.
Yeah, those are the common ones. Anything not on that list generally gets factored into the calculation of ordinary business income or loss back at the S-corp level.
So like regular sales revenue, cost of goods sold, salaries, rent expense, that's all part of ordinary income.
Typically, yes. But something like that, Section 1231 gain from selling equipment, separately stated because it might get taxed at lower capital gains rates for you, charitable contributions, separately stated because your ability to deduct them depends on your adjusted gross income AGI limits.
Makes sense. It preserves the character of the income or deduction, any other benefits flowing through.
Yes, another potentially significant one, the Section 199A, qualified business income, QBI deduction.
QBI.
Qualified business income. As an S-corp shareholder, you may be able to take a deduction on your personal return for up to 20% of the qualified business income that flows through to you from the S-corp.
A 20% deduction on top of everything else.
Potentially, yes. There are limitations based on your overall income and the type of business, but it's another major tax advantage introduced a few years ago. It's a below-the-line deduction, reducing your taxable income.
Wow. Okay. What about fringe benefits, like health insurance? How does the S-corp handle deducting those? Is it different for owners?
It is, and this trips people up. Here's the rule. For regular non-shareholder employees and also for employee shareholders who own 2% or less of the S-Corp stock.
Okay, minor owners.
The fringe benefits the company pays for them, like health insurance premiums, are deductible by the S-Corporation. They reduce the ordinary business income that flows through. Simple enough. What about owners with more than 2%? Like the founder.
Ah, different rule. For employee shareholders owning over 2%, the cost of those fringe benefits is not deductible by the S corporation in calculating ordinary income, unless the corporation includes the value of that benefit in the employee shareholder's W-2 income.
So to get the deduction, the S-Corp has to treat the benefit as taxable wages to the over 2% owner.
Exactly. The health insurance premium, for example, gets added to their W-2 Box 1 wages. Then, the S-Corp can deduct it as compensation expense. The shareholder reports it as income, but they might then be able to deduct it on their personal return as self-employed health insurance, assuming they meet the rules. It's a specific mechanism.
Okay, that's a really important distinction for owners. Let's see this in action. Can you walk through an example, calculating ordinary income and pulling out those separate items? Absolutely. Let's use illustrative example 2. Ordinary business income and separately stated items. Imagine Gray Corporation, an S-Corp. Here are their numbers for year 1. Gross income, $150,000. Cost of goods sold, COGS, $70,000. Interest income from investments, $10,000. Section 1231, gain from selling equipment, $5,000. Salary expense, including reasonable owner salaries, $40,000. MCRS depreciation expense, regular depreciation, $10,000. Charitable contributions made by the company, $5,000.
Okay, a mix of stuff there.
Right. So first, let's calculate Gray Corp's ordinary business income. We take the items that are not separately stated. Start with gross income, $150,000. Subtracts COBS, net interest, $70,000. Subtract salary expense, net interest, $40,000. Subtract MCRS depreciation, net just $10,000.
Right.
That gives us $150,000, $70,000, $40,000, $10,000, $30,000. That's the ordinary business income that flows through to the shareholders' K-1.
And the other items?
Those are the separately stated items. The $10,000 interest income flows through separately. The $5,000 Section 1231 gain flows through separately, potentially getting capital gains treatment for the shareholders. The $5,000 charitable contributions flows through separately, subject to individual AGI limits for the shareholders.
Got it. So the K-1 would show $30K ordinary income, $10 interest, $5 K Section 1231 gain, and $5K charitable contribution as a deduction.
Precisely. And here's the passkey reinforcement. Shareholders include their share of each of these items, the ordinary income, and all the separately stated ones on their individual tax returns, whether or not any cash was actually distributed to them. Taxed on the earnings, not the distributions.
That point keeps coming back. It's clearly important.
It is, and let's make this even more real world. Think about tax software. CPAs use it, obviously. Sometimes the software flags potential issues or things get entered incorrectly. Understanding these rules helps you spot potential errors.
Like diagnostics in the software.
Exactly. Imagine Mary, a CPA, preparing the Form 1120S for Acme Company. Here are some common issues she might see flagged relating directly to what we just discussed. Common tax trap 1. Mishandling gains on Form 4797, the issue. Acme sold some business property and had a $15,000 gain. Someone manually entered that $15,000 gain directly into ordinary business income on page 1 of the Form 1120S. The software might flag this as unusual. The correction: Mary needs to check Form 4797, sales of business property. If that $15,000 gain was actually a long-term capital gain resulting from Section 1231 netting, often reported on line 9 of Form 4797, it should not be an ordinary income. It needs to be separately stated on Schedule K and the shareholders' K-1s. Only ordinary gains from Form 4797, like from depreciation recapture, line 17, belong on page 1, line 4. Getting this wrong means shareholders might pay tax at higher ordinary income rates instead of lower capital gains rates. Big difference. Common tax trap 2. Lumping Section 179 with MCRS depreciation. The issue: Acme took $12,000 in regular MCRS depreciation and also elected an $8,000 Section 179 deduction. Someone manually overrode the software and combined these, reporting $20,000 total depreciation expense within ordinary business income on page 1. The correction: Mary knows that MCRS depreciation, $12,000, is part of ordinary business income. But the Section 179 deduction, $8,000, is a separately stated item. Why? Because the Section 179 deduction has its own annual limits at the taxpayer level. For 2023, for example, the limit was $1,160,000. It started phasing out if you placed over $2,890,000 in service, and it's also limited by taxable income. These limits apply to the shareholder, not just the S-Corp. So it has to flow through separately, Schedule K, line 11, so the shareholder can apply their own limitations. The override needs to be removed, or the amounts correctly allocated. Common tax trap 3. Incorrectly deducting owner health insurance. The issue. Acme deducted health insurance premiums for all employees, including its majority shareholder employee on page 1, line 18, employee benefit programs. The correction. Mary needs to verify. The deduction on line 18 is only for premiums paid for employees owning 2% or less of the stock. For the majority shareholder, a 2% owner, those premiums are not deductible by the S corporation on line 18 unless they were included in that shareholder's W-2 wages. If they weren't included in the W-2, the deduction needs to be removed from line 18. If they were included in the W-2, they'd typically be part of the salary expense deduction, line 7 or 8, not line 18. It ensures the benefit cost for significant owners is handled correctly as compensation.
Wow, those examples are fantastic. They really show why these distinctions matter in practice and how easy it could be to get wrong without careful attention. Okay, so we understand what flows through. Now, let's get to this concept of basis. You said it's fundamental, it sounds technical, but why is it so crucial for me as a shareholder?
You're right. Basis sounds technical, but it's probably one of the most critical numbers you need to track as an S-Corp shareholder. Think of it as your tax investment in the company. It dictates two huge things: how much loss you can actually deduct and whether the distributions you receive are taxable or tax-free.
Okay, so it limits losses and affects distributions. How is it calculated?
Your stock basis is essentially a running tally. It's not static. It changes constantly based on the S-Corp's activity and your transactions with it. Here's the basic formula. You start with your initial stock basis. That's usually what you paid for the stock or the value of property you contributed for it. Then you ADD any additional capital contributions you make. You ADD your share of all income items that flow through ordinary income, separately stated income gains, and even tax-exempt income.
Wait, tax-exempt income increases basis?
Yeah.
Even though it's not taxed?
Yes, because it still represents an economic increase in the value of your investment, even if you didn't pay tax on it. So it increases your basis, allowing you to potentially take that value out later tax-free.
Interesting. Okay, what decreases basis?
You subtract any distributions you receive from the S corporation. We'll talk more about how these are taxed later, but they reduce basis.
Okay.
You subtract your share of any non-deductible expenses of the S corp, things the S corp paid but couldn't deduct, except for expenses related to that tax-exempt income. And you subtract your share of all loss and deduction items, ordinary business loss, separately stated losses and deductions, and that gives you your ending stock basis for the period.
That's a lot of moving parts.
Yeah.
Now, I remember you saying S-Corp basis is different from partnership basis regarding debt. Could you clarify that key distinction again?
Absolutely critical difference. Unlike partners in a partnership, S corporation shareholders do not get to include any share of the S corporation's debt, like bank loans taken out by the S corp itself, in their stock basis.
So if the S-Corp borrows $1 million from the bank, my stock basis doesn't change.
Correct. Your stock basis is generally limited to your direct investment in the stock.
But what if I lend money to the S-Corp directly?
That's different. An S corporation shareholder does get a separate debt basis for any loans made directly from the shareholder to the S corporation.
So I have my stock basis and potentially a separate debt basis if I loaned the company money.
Exactly. Two separate basis tracks. And if the S corporation repays part or all of that direct loan you made, your debt basis is reduced by the repayment amount.
Okay. And can basis go negative if I get lots of distributions or losses?
No, that's a fundamental rule. Both your stock basis and your debt basis cannot be reduced below zero. This floor is what creates the loss limitation we need to talk about. Let's make this concrete with illustrative example 3. S corporation shareholder stock and debt basis. Facts. Let's go back to Jane Gray, our 50% shareholder in Gray Corp. Start of year 1, her initial stock basis was $25,000. She also personally loaned Gray Corp $20,000 right at the beginning of the year. During year 1, Gray Corp repaid $2,000 of that loan principal to Jane. Jane also got a $10,000 cash distribution. Remember Gray Corp's year 1 numbers: $30K ordinary income, $10K interest income, $5K Section 1231 gain, $5K charitable contribution.
Okay, same facts as before. Let's calculate Jane's basis.
First, Jane's 50% share of each item: $15 ordinary income, $5K interest, $2 5Ks, Section 1231 gain, $2 5K charitable contribution. Now Jane's year 1 ending stock basis. Start $25,000. Add ordinary income share plus $15,000. Add interest income share plus $5,000. Add Section 1231 gain share plus $2,500. Subtotal before deductions distributions: $47,500. Subtract cash distribution, manage $10,000. Subtract charitable contribution share, manage $2,500. Subtract charitable contribution share. Ending stock basis equals $35,000, $47,500, $10,000, $2,000 night. Next, Jane's year one ending debt basis. Start with the loan she made, $20,000. So at the end of year one, Jane has $35K in stock basis and $18,000 in debt basis. Both are positive.
That calculation makes sense. So you mentioned basis limits losses. How exactly does that tax basis limitation work? What if the loss is bigger than my basis?
This is where that cannot go below zero rule really bites. The rule is a loss flowing through from an S corporation can only be deducted on your individual return to the extent of your total tax basis.
Total meaning.
Meaning the sum of your stock basis plus your debt basis from those direct loans you made. That combined amount is your ceiling for deducting losses in any given year.
Okay. So what happens to the loss above that ceiling? Does it just disappear?
No, thankfully not. Any loss in excess of your total tax basis is suspended.
Suspended, like put on hold.
Exactly. It's carried forward indefinitely until you have sufficient basis in future years to absorb it.
How do you get basis back to use those suspended losses?
You reinstate basis through future events that increase basis,
Yeah.
primarily your share of future S-Corp income or gains, or by making additional capital contributions or loans to the S-Corp.
And is there an order? If I have income next year, does it restore stock basis or debt basis first?
Good question, yes. There's a specific order of reinstatement. Any future basis increases, like from income, go to restore your debt basis first, up to its original amount. Only after debt basis is fully restored do further increases go to your stock basis.
Debt basis gets restored first.
Yeah.
Okay. What's the ultimate fate of suspended losses if I never get enough basis back?
They carry forward indefinitely while you own the stock. But, and this is a huge 8-point point, any suspended losses due to insufficient basis that are still unused when you dispose of your S corporation stock, sell it, gift it, etc., are lost forever.
Lost forever.
Wow.
Use it or lose it, literally.
Literally. You can't deduct them after you've disposed of the stock. That's why managing basis and utilizing suspended losses before a sale is critical.
Okay, this sounds like it could get really complicated if you have losses one year and income the next. Can we walk through a multi-year example showing the limitation, the suspension, and the reinstatement?
Absolutely. This is where it all comes together. Let's tackle illustrative example 4. S corporation shareholder tax basis limitation. This needs careful step-by-step attention. Facts. We continue with Jane Gray, 50% owner of Great Core. Beginning of year 2, stock basis equals $35,000. Debt basis equals $18,000. Total basis equals $53,000. Beginning of year 2, in year 2, Great Core has a huge ordinary business loss of $120,000. Beginning of year 2, in year 3, Great Core bounces back with ordinary business income of $60,000. Beginning of year 2, assume no other items, distributions, or loan changes in year 2 or 3 for simplicity.
Okay, big loss in year 2, then income in year 3. Let's break down year 2 first.
Year 2 analysis, the loss here. Jane's 50% share of the $120,000 loss is $60,000. Her total available basis at the start of year 2 was $53,000, $35K stock plus $18K debt. The basis limitation kicks in. Jane can only deduct the loss up to her basis, so she can deduct $53,000 of the loss in year 2. The basis limitation kicks in. Now, how does that $53,000 deduction affect her basis? Losses reduce stock basis first, then debt basis. The basis limitation kicks in. The first $35,000 of the loss reduces her stock basis from $35,000 down to $0. The basis limitation kicks in. The remaining $18,000 of the deductible loss, $53,000 total $35,000, then reduces her debt basis from $18,000 down to $0. The basis limitation kicks in. What about the rest of her loss share? She had a $60,000 loss share, but only deducted $53,000. The difference? $7,000, $60,000, $53,000 is a suspended loss. It carries forward to year 3.
Okay, so year 2. Deducted $53K loss, basis wiped out to 0, both stock and debt, and $7K loss suspended. Now, what happens in year 3 with the income?
Year 3 analysis, the income year. Jane's 50% share of the $60,000 income is $30,000. This $30,000 income first goes to reinstate basis. Remember the ordering rule. Debt basis first. This $30,000 income first goes to reinstate basis. Remember the ordering rule. Jane's debt basis was $0. The first $18,000 of the year 3 income goes to restore her debt basis back up to its original $18,000 level. This $30,000 income first goes to reinstate basis. Remember the ordering rule. How much income is left? $30,000 total share. $18,000 used for debt basis equals $12,000. This $30,000 income first goes to reinstate basis. Remember the ordering rule. This remaining $12,000 now increases her stock basis from $0 up to $12,000. So after basis reinstatement, Jane's basis is. Now what about that $7,000 suspended loss from year 2? Jane now has sufficient basis, $30,000 to utilize it. So after basis reinstatement, Jane's basis is. The $7,000 suspended loss flows through in year 3 and reduces the amount of year 3 income she actually reports. The net income Jane reports from Gray Corps for year 3 is $30,000 year 3 income share, $7,000 year 2 suspended loss utilized equals $23,000.
So the suspended loss offsets the current year income once basis is restored.
Exactly. And finally, what's Jane's ending basis at the end of year 3? Debt basis. It was fully restored to $18,000. Stock basis. It started year 3 at $0, increased to $12,000 after debt reinstatement, and then was reduced by the $7,000 suspended loss that was deducted. So $0 plus $12,000, $7,000, $5,000. Stock basis. So at the end of year 3, Jane has a $5K stock basis, $18K debt basis, and no more suspended losses.
Wow. That example is incredibly helpful, walking through the reduction, the suspension, the specific reinstatement order, and finally using the suspended loss. It's complex, but makes sense when you follow the steps. Okay, we've covered basis, which limits losses and affects distributions. Now, there's one more big piece you mentioned, the accumulated adjustments account, or AAA account to say. What is this AAA, and why does the S-Corp need to track it, especially for distributions?
It does sound accountantly, doesn't it? But it's a crucial account for S corporations, particularly those that have ever been C corporations or plan to make distributions. Think of the AAA as a special corporate-level account that tracks the cumulative taxable income earned while the corporation has been an S corporation, which has already been passed through and taxed to the shareholders.
So it's like a running total of the S-Corp's taxed earnings.
Essentially, yes. Its
Yeah.
main purpose is to help determine the tax treatment of distributions made to shareholders. Distributions are generally tax-free to the extent they come out of this AAA balance because that income has already been taxed to the shareholder via the flow-through mechanism.
Okay, so AAA tells us how much can be distributed tax-free.
That's the primary idea, yes. Now, a key rule related to AAA. Distributions generally may not reduce the AAA balance below zero.
Similar to basis.
Sort of, but with a twist. While distributions can't make AAA negative, the AAA can become negative if the S corporation has cumulative losses and deductions that exceed its cumulative income earned during its S period.
So losses can drive it negative, but taking money out, distributions can't.
Exactly. That makes sense because distributions are supposed to represent previously taxed income. If losses have wiped out that previously taxed income, pushing AAA negative, distributions can't create a tax-free return from a negative balance.
Okay. What specifically makes AAA go up and down?
Similar to basis, but with some key differences. Increases to AAA come from ordinary business income, separately stated income and gain items. But with a major exception, tax-exempt income does not increase AAA.
Oh, tax-exempt income increases basis, but not AAA.
Correct. That's a critical distinction.
Yeah.
Tax-exempt income increases your investment basis, but doesn't represent taxable S-Corp earnings.
Got it. What about decreases?
Decreases to AAA come from ordinary business losses, separately stated losses and deductions, non-deductible expenses, again, with an exception. Expenses related to tax-exempt income do not decrease AAA.
Okay, another parallel difference from basis.
Right. And finally, distributions decrease AAA, but again, only down to zero. They can't make it negative.
This seems like it needs an example too, especially seeing it go negative with losses.
Definitely. Let's use illustrative example 5, S Corporation Accumulated Adjustments Account, AAA. We'll follow Gray Corps again using the same numbers from year 1, year 2 loss, and year 3 income. Facts recap. Year 1, $30K ordinary income, $10K interest income, $5 stay, section 1231 gain, $4K charitable contributions. Let's use $4K here to make numbers slightly different from basis example. $21K cash distributions. Year 2, $120K ordinary business loss. Year 3, $60K ordinary business income. Year 3. Assume Gray Corps started with $0 AAA when it became an S Corp. Year 1 AAA calculation. Start AAA at $0. Add ordinary income plus $30,000. Add interest income plus $10,000. Add section 1231 gain plus $5,000. Subtract charitable contributions minus $4,000. Subtract charitable contributions. AAA before distributions equal $41,000. $30K plus $10K plus $5K, $4. Subtract charitable contributions. Year 1 ending AAA $20,000. $21,000. Year 2 AAA calculation beginning AAA from year 1, $20,000. Subtract the ordinary business loss, $920,000. Subtract the ordinary business loss, made it $120,000. Subtract the ordinary business loss. Remember, losses can make AAA negative. Subtract the ordinary business loss. Year 2 ending AAA equals that $20,000, $120,000. Year 3 AAA calculation, beginning AAA from year 2, $100,000. Add ordinary business income plus $60,000. Add ordinary business income. Year 3 ending AAA equals $40,000, make us to $100,000 plus $60,000.
So after 3 years, even with some income, the big loss kept the AAA balance negative. What does that negative AAA mean practically if Gray Corps distributes money in year 4?
Good question. A negative AAA balance signals that the S corporation's cumulative S period losses and deductions have exceeded its cumulative S period income. If the corporation makes distributions while the AAA is negative, those distributions cannot be treated as tax-free distributions from AAA because it's negative. The tax treatment would then depend on whether the corporation has any prior C corporation earnings and profits, E&P, and the shareholders' remaining stock basis. It often means distributions could be taxable dividends if C corp E&P exists, or a return of capital reducing basis further, or even capital gain if basis is zero. The negative AAA basically removes that first layer of tax-free distribution potential until future earnings bring it back above zero.
Wow, okay. What a journey we've taken. From figuring out what an S-corp even is, to who can be one, how to elect it, how you might lose it, and then really diving deep into how the money flows through, that critical basis concept limiting losses, and this AAA account tracking taxable earnings for distributions. It's a lot,
Yeah.
but I can see how each piece fits together for tax efficiency.
It is a lot, you're right, but that's the so what, isn't it? Choosing S-corp status and maintaining it correctly isn't just a simple tax trick to avoid double tax. It demands, well, strategic thinking, meticulous record keeping, and a real understanding of how the business's finances directly hit your personal tax return as a shareholder.
Yeah.
Those distinctions we talked about, ordinary income versus separately stated items, the crucial difference between S-corp debt and shareholder debt for basis, how losses get suspended, the AAA rules, they aren't just theory. They have a direct impact on your tax bill, your cash flow, your planning. Knowing this stuff really empowers you.
Absolutely. So as we wrap up this deep dive, here's a final thought for you listening. Reflecting on all this detail, if you're involved with a small business now, or thinking about one, what's one immediate question this raises about your situation? What conversation do you need to have, maybe with your tax advisor? And how does understanding the why behind these complex rules make you feel more prepared for that conversation? Really appreciate you joining us today and digging into the nitty-gritty of S corporations. Hopefully this leaves you feeling more informed, maybe a little less intimidated by the tax code. Keep exploring, keep asking questions. We'll catch you on the next deep dive.